Recent political uncertainty in the UK has coincided with continued movement in mortgage pricing from banks and building societies. If you're wondering whether now could be a good moment to consider a sub-4% Bank of England tracker mortgage, the timing is certainly interesting. Some borrowers may be concerned that political uncertainty could affect mortgage rates, but for now lenders are still pricing competitively, which is giving borrowers more choice. Over the last few days, there have been more fixed rate pricing improvements, so the big question is whether a low tracker rate could be worth weighing against the security of a fixed deal. In this video, we'll look at what rates are doing, why trackers are getting more attention, and what it could mean if you're trying to choose a mortgage that fits your circumstances. Barclays has reportedly lowered rates twice in a week, and lenders including Nationwide and HSBC have had 2-year fixes starting at around 4.3%. These are useful market examples rather than guarantees of what will be available by the time someone applies. What they do suggest is that some lenders are still adjusting pricing competitively, including those aiming to stay near the top of the best buy tables. For borrowers, that may be encouraging because it points to a market where pricing is still moving and product choice remains active. Rates coming down may be positive news for borrowers because lower pricing can mean cheaper monthly repayments and more choice when comparing deals. Some people may still be watching political and market uncertainty closely because that can affect sentiment and pricing, but it is difficult to know exactly how things will move. At the moment, some lenders are still trimming rates, which may give borrowers a useful opportunity to review their options carefully rather than feeling they have to rush. For those with larger deposits, some of the lowest tracker rates are currently coming in below some competitively priced 2, 3 and 5-year fixes. There are only a handful of lenders offering sub-4% trackers, while others are priced at roughly 0.30% above the current Bank of England base rate. In some cases, that is also around 0.30% lower than many fixes at the moment, although the right choice will still depend on individual circumstances. There have been fairly strong expectations that the Bank of England base rate could rise this year, although recent comments from the Bank of England governor suggest any move is not necessarily imminent. A July rate rise remains a possibility, even though a June move did not happen. The Bank of England kept the base rate at 3.75% at its June 2026 meeting, and the decision still reflected some caution about inflation, energy prices, and wider geopolitical uncertainty. At the same time, the UK economy has looked relatively weak, which can also influence expectations for future rate decisions. This is one reason tracker mortgages are back in the conversation. Some borrowers may be concerned that political or market uncertainty could affect rates, but for now, lender pricing remains competitive. If the economy stays soft and inflation becomes less of a concern, the Monetary Policy Committee may eventually feel able to cut rates. If inflation stays persistent or energy prices rise again, borrowers on trackers could instead see payments increase. Tracker mortgages may appeal at the moment because some are cheaper than fixed rates and many have no early repayment charges. They can suit borrowers with savings, strong affordability and a willingness to accept payment changes, but they are not right for everyone. Anyone stretching their budget may prefer the certainty of a fixed rate. 2 and 5-year fixes remain popular, while some borrowers are also looking more closely at trackers as part of a wider review of their options. To give you a sense of how competitive the market looks, it helps to look at a few illustrative fixed rate snapshots. Barclays has had a 2-year fix at around 4.3%, a 3-year fix at around 4.4%, and a 5-year fix at around 4.4%. These kinds of examples can change quickly, but they do show lenders working hard to stay competitive as borrowers compare deals across the market. Looking at a couple more examples, Nationwide has also had home mover rates with a 2-year fix just below 4.3%, a 3-year fix just below 4.5%, and a 5-year fix below 4.35%. HSBC has also been competitive, with trackers priced below or around 4% and fixes around 4.35%. Taken together, these are helpful snapshots of a market where major lenders are still competing actively, although exact products and pricing can change at any time. So, is it time to take a sub-4% tracker mortgage? For For some borrowers, especially those with larger deposits and a preference for flexibility, it may be an option worth considering. A low tracker can offer a cheaper starting rate and the freedom to switch later if fixed deals improve. But the right choice still comes down to your own circumstances, how comfortable you are with rates moving, and whether flexibility matters more to you than payment certainty. Fixed deals may still suit other borrowers better, especially those who want more stability in their monthly payments. If you'd like help working out whether a tracker or a fixed rate might suit you, you can speak to Trinity Financial for personalised guidance and read the blog for more detail. The information in this video was correct at the time of publication, but it may change. It is intended for general information only and is not advice.